Welcome to our wealth update for spring 2021. Joining me today is Mr. Craig Holly. How are you, Craig?
Good, thanks, Matt. Great to be back.
Yep. So this should only take probably 5 minutes, hopefully, of your time, but we'll run through what we're up to here at Verve Group at the moment. So a lovely general advice warning there, Craig.
Yeah, everything here is general in nature, guys, so nothing personal. So if you want personal advice, just reach out to us directly and more than happy to help.
Wonderful.
So today's agenda, we've got some super law changes coming up. We've got some income protection changes and lucky last, got some action plans. So Matt, what's happening on the super side of things?
So plenty of change from July. So obviously, as most people would know, your super guarantee from your employer went up to 10%. So you should be all getting a little bit extra super, and that's increasing up to 12% over the next 4 years, so 4 or 5 years. So that'll help boost people's retirement savings. The contributions caps increased as well. So the old was 25,000 you could put in concessionally into super's now gone to 27.5, and the 100,000 non-concessional after tax, as some people call it, has gone from 100 up to 110 or 330 in using the bring forward rule. So that just increases about every 3 years. Those caps increase. Obviously, inflation goes up, so they creep up as well. The moving forward, sort of 12 months time, this is probably a big opportunity for a lot of people. Whereas if you weren't working over the age of 67, you couldn't contribute to super, or most people couldn't. But now they're potentially going to open up being able to make non-concessional contributions to super. So if people inherit money, sell a property, etc., there may be an opportunity, if this gets legislated in the next 9 months, to dump extra money into super from July 22 onwards for the 67 to 74s. So that opens up a heap of planning opportunities for people. So the government obviously want us to fund ourselves as much as possible. So they're putting a few carrots there for people to get money into super. The bring forward rule will also come into play as well. So this is all potentially going to happen in 2022. So the 110 or 330 in one hit. So as this gets legislated, we will confirm it in these updates, but it's going to be advantage to a lot of people to be able to use these bring forward rules. And then the other one that generally doesn't affect too many people at the moment, but the downsize of contributions. So if you sell your house, used to be over 65, and you can put up to $300,000 each into super, and there's some rules around that, but they're going to reduce that down to age 60 is what they're proposing. So just freeing up, loosening the strings a little bit so people can get more money into a very good tax-friendly savings environment, which is superannuation. So a little bit happening. We'll keep you updated over time though in regards to that. So the next one, Craig, I believe income protection, a lot of changes happening at the moment in regards to that.
Yeah, definitely. Thanks for that, Matt. That's great. Yeah, there's a lot happening, particularly on income protection, but more broadly, insurance in general. So many of you probably would have received increased letters recently, which may have shocked you. There's been some pretty heavy premium increases, unfortunately. But long story short, in terms of income protection, there's been, in the past, there's been pretty generous features on the policies, increasing in claims, and plus, as you can see there, over $3 billion in losses over the last 5 years, which unfortunately has meant higher premiums and some policy changes, which I'll go through here, which is both super and non-super policies. So the first one last year was no agreed value policies anymore. So long story short, insurance companies thought it was better to reflect your actual income at claim as opposed to applying an agreed value based on when you first started the policy. And it meant that they generally averaged your claim under the new terms over the last 3 years, But then just recently, this month in October 2021, some more changes have come in just to keep us on our toes. So now for a brand new policy, any claim you have on that income protection policy is generally going to be based on your last 12 months of income. It may be a bit more lenient for some specific occupations, but that's generally speaking the last 12 months. So more to reflect your actual income at claim time. Another big change is the maximum claim in the first 6 months is going to be 90%, as opposed to some policies at the moment that you can actually get it up to 100% or more out of these policies if there's extra little benefits thrown on top of your monthly benefit. And then after the 6 months, it's capped at 70%, which is a little bit lower than the 75% generally in place at the moment. And the third change on there is every 5 years, you're going to need to apply for a new policy, which is a little bit different to how the current grandfathered policies have gone. So it's no longer guaranteed renewable policy. You're going to have to apply for a new one under the current terms at the time with the insurance provider. But the good thing there is you won't have to go through medicals again, providing you do it within the 5 years, is what we're being told at the moment. But it may change if for example, if your salary's changed, if your employment occupation duties have changed, then you may be worse off, but you can look at it as a good thing. You might actually move into a policy that's you're better off under. So it just depends. Everyone's different. And the main reason they're doing this is sustainability of the industry, to make sure these insurance companies can keep paying claims over the future, and they're actually a sustainable business. And the other important thing is that pre 1st of October 2021, policies are grandfathered under the old rules. And yeah, long story short, it's a good time to give your policies a health check. So if anyone's received any letters recently, feel free to reach out to us. We can do some comparisons for you, show you what you're covered for and what you potentially can move into under the new terms.
Beautiful. Thanks for that, Craig. Obviously, as you can see, a lot of change happening. And yes, insurance is a very dry subject, but probably income protection insurance, people's ability to earn their wage, and especially what we've seen the last probably 18 months, 2 years with COVID, where people's incomes have been knocked around a fair bit. When that gets impacted, that hits the family's bank account well and truly. So there's ways and means to, and this is obviously income protection's accident and illness, so it doesn't cover COVID-related things, but yeah, it's certainly something that people need to look at. So take action in regards to some of these things. A lot of people, especially in the last 12 months, have had time to sit back and rethink plans or change what they're looking at doing going forward. So what a lot of the time can happen is people wait till they're about to retire and think, heck, I need to do something about my super, or how does this age pension scenario work, etc. So where we can add a lot of value is if people take action early, and early is probably 5 or 10 years out at least, because we can hopefully help guide people and make some big changes that'll have a big impact on that final dollar amount they may receive. And as you saw with a lot of the super laws changing, that changes regularly. So being up to date and making sure you're getting the maximum bang for your buck in regards to your super as well. Obviously, people have seen with COVID, markets go up and down all the time, but the longer you obviously invest, compounding works for you and evens out your returns. So that's like point one, take action early. If you are in for the long haul, it'll smooth out the ups and downs. So obviously everything's looking not too bad at the moment. Everything's bounced back pretty well, but knowing being in this industry for 20 odd years, there will be another crisis in the future. So no doubt about that. So our initial appointment's free of charge, so it doesn't cost you to sit down and have a chat. It's very high level. Just have a general chat about what you're looking at, what your situation is, how we work, and then we can go from there. So we're quite happy to do that. And obviously, And these days and times, whether that's face-to-face, whether that's Zoom or on the phone, we're happy to fit into people's busy lifestyles because it's some people obviously interstate or lockdown. We can't freely fly like we used to at the moment, so we're doing a lot more Zoom appointments, and it works quite well and become part of people's day-to-day lives. So short and sharp today, Craig. A couple of areas there for people to look at. So I think from myself and Craig, have a great day. So thanks, Craig.
Right, thanks, Matt. Cheers. Thanks, guys.